Hello, my name is Bob Gilbert. I'm a partner in Citron Cooperman's hospitality practice, and this webinar is intended on getting the hospitality industry up to speed on the most recent legislation, including the second round of PPP and changes to the employee retention tax credit.
So a little bit of background, the Consolidated Appropriations Act was signed December 27, 2020. Both sides went back and forth for probably 9 months on trying to release what I guess would be stimulus number 2. And in doing that, there was so much added to this bill where everyone just wanted something out of it, and it became the largest bill ever at 5,600 pages. And we're just going to focus on the general small business provisions. Interim final rules on PPP changes were issued on Wednesday night, so I saw them yesterday. This webinar will not be discussing things that are potentially relevant to some of you. So I'm not going to talk about pandemic unemployment insurance, the direct cash payments, $600 that a lot of people talk about, assistance to low-income communities, that's where new EIDL money comes into play, extension of FFCRA tax credits, and expansion of several other income tax provisions related to development, energy, and employment. So understand that there's a lot in this law that it's just too much to cover in a 1-hour webinar. What we will be discussing is deductibility of PPP costs used for forgiveness, modifications to round 1 PPP, the second draw for PPP, round 2, grants for shuttered venue operators, which is a new program, extension of the traditional SBA relief. This was a 6-month SBA subsidy where SBA was paying existing loans for 6 months. And these last 2, changes to ERTC eligibility and extensions and modifications to ERTC. This program never got enough love, and I still don't think it's getting enough love. Pay attention to these last 2, to the items on ERTC. Big dollars at play, and it's now opened up to a much bigger crowd. The deductibility of PPP. I don't know if everyone even knew that Treasury figured out kind of a back-end way to tax the PPP receipt. I think a lot of people thought it was tax-free, and then what the Treasury did is they said, well, you don't have to pay tax on the receipt, but you can't deduct the expenses used to get forgiveness, which gets you to taxability on receipt. Congress clarified their original intent 2 weeks ago, saying that no, that there's no disallowance of deduction and there's no taxability on receipt. It's tax-free. So for people that got significant PPP loans, that's big dollars. I don't know if people had projections being prepared for them over the last couple of months, but they might have saw that there was a big switch from PPP being taxable versus not taxable. So no taxability on that. Also, the EIDL advances are no longer taxable. That was the up to $10,000 that some people got for after applying for an EIDL loan. Sba Subsidy Payments, so the 6-month SBA payments on traditional SBA loans that the SBA was making on borrowers' behalf, that is no longer taxable. Grants for shuttered venue operators, which we will discuss, will not be taxable. And kind of a random but probably helpful provision is businesses can deduct 100% of meals when provided by a restaurant for 2021 and 2022. So there's a limited opportunity where businesses can get what's called a 3 martini lunch. They can get a full deduction for working lunches. So potentially this incentivizes businesses to eat out a little bit more. All right, modifications, PPP round 1. Even if you are already comfortable that you're getting full forgiveness, you should still pay attention and understand these additional expenses because they apply to round 2 as well. I mean, these were all written in the form of amendments to existing law. And then from there, there's what carries on to round 2. But first, we'll talk about the amendments that go back. So simplified forgiveness application, loans of $150,000 or less will have a 1-pager just stating number of employees, estimated amount spent on payroll, total loan value, and an attestation that you complied with the program. So you'll still want to do your homework and make sure that the numbers add up, and you'll want to retain records for at least 4 years because the SBA can review any of these applications. But $150,000 or less, the application is one page. Eligible non-payroll expenses. So additional items are included in that 40%. The 60-40 allocation of payroll versus non-payroll is still in play, but there, if you didn't have enough rent, utilities, or mortgage interest, there's other items that are now in play. One of them being covered operations expenditure. So there's a lot of activities included in that, but the first couple words is software or cloud service. So, I'm thinking about payroll processing or credit card processing. Based on these tests, it does seem that those would be fitting, but are those services really software or cloud services? I'm not sure. But this is the definition we have at this point. That the rules didn't clarify it. I'm thinking an FAQ might, give an example of just, those two items are relevant to almost every business. So I'm thinking we'll get a little bit more clarity on that. Covered property damage costs. So any costs related to vandalism or looting that occurred during 2020 that was not covered by insurance is now eligible. Covered supplier costs. Payment for supply of goods that are essential to operation pursuant to a contract or purchase order in effect at any time before the covered period. So that first provision tells me, okay, if I have a purchase order outstanding, or in my mind, an invoice really, so any accounts payable for goods that are essential to operations that I'm paying for during my covered period, those would now be eligible. So pretty much everything in accounts payable when you apply for the loan that's essential to the goods that are essential to the operation would be an eligible cost. For perishable goods, the order can be effected before or at any time during the covered period. What that means is it's not accounts payable, when you get the loan, it's all of your food costs throughout the covered period, unless it's non-perishable canned goods. Between that and rent, you're probably going to be at that 40% pretty easily. Covered worker protection expenditure. This is another newly eligible cost. So anything to facilitate the adaptation of the business activities of an entity to comply with requirements established or guidance issued by the government. So this is kind of a vague topic, but it does include capital expenditures. People are asking me, what about the tent setup and the patio and all that stuff? It includes capital expenditures. Examples that they included in the law itself was purchase to create a drive-through window facility, filtration systems, physical barriers, expansion of indoor, outdoor, or combined space, healthcare screening, or other assets related to compliance with health and safety standards and guidance. There's other examples. A lot of them are pretty vague, which is usually a good thing, allowing for more flexibility. So, any of the adaptive costs you had to undergo to comply with either outdoor dining or 25%, or the sneeze guards, like things like that, that's now a covered worker protection expenditure. The rent, utilities, mortgage interest still in play as non-payroll costs. These amendments are not applicable to borrowers that already received their forgiveness from the SBA, so that's done with. But the amendments appear to be applicable to borrowers that applied, but the SBA has not yet remitted the forgiveness payment yet. So I guess if your application is still in limbo at this point, I'm not sure if it changes anything, then perhaps either the lender or the SBA reaches out to you and says, okay, do you need to adjust for newly eligible costs? Okay, second round of PPP. Need to be operating on February 15, 2020. Employ 300 people or less, and incurred a 25% or more reduction in gross receipts in any quarter when compared to the same quarter in 2019. I thought that was interesting because, when I thought 25%, I thought for the year or, a combination of a certain period, but any quarter from 2020 to 2019, Q2 kind of happened to be like, March 16th to June 15th, I think it was. A lot of businesses were on complete lockdown, especially restaurants. So I think it's pretty easy to just take Q2 alone and say, okay, that quarter we were definitely down 25%. If you have to look at other quarters, go ahead. If you did it for the whole year, the bank would accept that as well, just because that means that there had to have been one quarter that was down. It's really any quarter from 2020 to 2019, even if you had some good quarter, a good Q3. You will need to substantiate the decrease in gross receipts. So quarterly sales tax returns should do the trick. If your loan is under 150,000, then for whatever reason, that support needs to be provided on the forgiveness application, but not on the borrower application. So you still need to substantiate. It's just a timing difference for loans below 150 grand. And the new loan application will be Form 2483 SD. So just in case you don't know what application you're going to be filling out, the second draw is going to be 2483 SD. If not in business during the measurement periods, there are accommodations, meaning if you weren't in business during 2019, but you were an operation at 2/15/20, then you can compare a reduction from Q1 2020 to the following quarters of 2020 to demonstrate that 25% reduction. Eligibility also excludes entities that received shuttered venue operator grants. Again, we'll talk about that and you'll see why it would exclude them. Must have used or will use the full amount of an initial PPP loan before being eligible for second draw. So it's unclear what will use means. I do have clients that they've been completely shut down. It just never made sense for them to open. So they're kind of still sitting with some or a lot of PPP money. So to me, they have to spend that on eligible costs. And maybe they did spend it on eligible costs. It just wasn't eligible until now. Either way, that money has to have been spent on eligible costs before the second draw disbursement is made. I think that the term will use means the period between applying, like you're going to certify that I will spend the full amount of PPP money before receiving this disbursement. We'll have to see exactly what the certification says on that, but that's my take. And if that's the case, then and you need to spend more money, you kind of have to figure out, all right, what's the best, what's my best, if I have to get rid of this money to get a second draw loan and to keep my runway going, should I spend it on worker protection expenditures, supplier costs, rent? I mean, now you have a longer list of items to choose on how to spend that money on what's now considered eligible. You have to certify that current economic uncertainty makes the loan necessary to support its ongoing operations. And the covered period can actually be anytime in between 8 and 24 weeks after origination. Presumably Form 3509 for loans over $2 million will be necessary for round two. And that's the, certifying current economic uncertainty. That's a form where you kind of take a retroactive perspective to say, or a hindsight perspective to say, all right, we were, this was our revenues throughout the covered period. This was our net income. And it's a questionnaire. It tells the government really how much you needed that loan. I haven't seen any action on that yet. The form wasn't released until, form wasn't finalized until December for round one. So, but just understand that loans over 2 million will probably require a questionnaire whether or not the loan is necessary. Maximum loan amount. So it's generally 2.5 months of average monthly payroll, either using 2019, 2020, or preceding 12 months. It includes calculations for seasonal employees similar to CARES Act. It includes calculations for entities that did not exist 1 year preceding 2/15/2020. And the highlight is hospitality industry, businesses with NAICS codes starting in 7.2 get 3.5 times average payroll, still capped at $2 million. So just to do some quick math, for restaurants or anyone in NAICS code starting with 7.2, you're going to get 40% more in this round. So if you get 100K in round one, you could receive 140K in round two. If you're using the same lender, you apparently do not have to, if you're using the same lender and you want to use the same, let's say you used 2019's payroll to get to your average, you don't have to provide that payroll information again. The lender already has it. They already got comfortable with it. And instead of doing 2.5 times the average, they'll do 3.5. Other notes, so affiliation rules waived for NAICS code starting with 7.2, where employee count is per physical location. It was 500 per physical location. Now it's 300 per physical location. Eligible costs for forgiveness include additional costs explained in earlier slides. So that covered supplier, that worker protection stuff, that's all in play in round 2. Loans are available through March 31st, 2021. And loan maturity is 5 years at 1%, similar to, or same as what they were in the Flexibility Act. All right, grants for shuttered venue operators. I'm really just going to scratch the surface on this. So I'm going to discuss the legislation itself, my thoughts on it, and kind of what to think about or look out for. So a live venue operator, promoter, theatrical producer, performing arts organization, museum operator, movie theater, talent rep, are all the types of venues that should be eligible for this. There's many requirements, but 2 of the big ones is 70% of earned revenues generated through a live event, cover charge, production fee, or sale of event, food, beverage, and merchandise, or generally offers event tickets over 60 days in advance of the event. So, comedy clubs are specifically mentioned to be included in something like this. I don't think there's going to be an issue with that. But I'm thinking, I've had some conversations on nightclubs, and where I get hung up is the requirement to have a defined performance and audience space. And, I'm thinking, does a DJ platform that overlooks a dance floor count as a defined audience and performance space? If so, then every night is a performance event, and that allows the food and beverage from those events to demonstrate the 70% requirement. But I'm not sure if a nightclub, and by the way, they would have to charge a cover charge as well to be included in that. If you don't charge a cover charge, then that eliminates you as well. So a nightclub charges a cover charge, has live performance, whether it be DJ or band. The defined audience space is where I'm a little hung up on that. It excludes performance of prurient sexual nature. So my assumption is that gentlemen's clubs were specifically ruled out of this. Now that we talked about who may be eligible, the grant is 45% of the venue operator's 2019 revenues, capped at 10 million in the first round of grants. So it's essentially 6 months worth of revenue, 2019 revenue. If as of 4/1/2021, the revenues are no more than 30% of Q1 2019, meaning Q1 2021's revenues are 30% or less of Q1 2019, then a supplemental grant will be awarded at 50% of the initial grant. So, the way I understand this is you can get 10 million in the first round max, and another 5 million in the second round if you're eligible, or 45%. The 10 million is the cap. General requirements have to be in business February 2019, 2020, and show a revenue decline of at least 25%, which is probably most venue operators, even if they were operating at a somewhat lower capacity. Importantly, there's a priority in how these funds are distributed. The first priority is going to go to venues that had a 90% reduction in revenues. I believe the dates are April 1st, 2020 to 12/31/2020 compared to that same period in 2019. And then the second tranche is for those that had a 70% reduction, same period. And after that, it's 14 days of those 2 tranches. So the first 14 days goes to these guys, the 90% or more. Second 14 days is to the 70% or more. And then it opens up to everyone that had, a 25% reduction. And there's also some funds pulled aside for small businesses, I think less than 50 full-time employees, and yeah, there should be enough. The idea is for enough money to be around for even the little guys. Oops. Again, not going to go into any more detail than that, just because we don't have regulations. But if you have cover charges or sell tickets or something like that, something to keep our eye on. Extension of traditional SBA debt relief. This is some of you probably already participated in it, but if you had an existing SBA loan or if you originated one during 2020, the SBA covered 6 months worth of principal and interest payments. That program is being extended another 3 months starting February of 2021. It's being capped at $9,000 per borrower per month. And an additional 5 months payments will be made for borrowers in certain industries. Restaurants and accommodation industry entities can get up to 8 months worth of SBA payments. And this has nothing to do with PPP. This is traditional SBA debt that was taken on. Can get up to 8 months worth of P&I on these loans. All right, ERTC. So the headline is PPP recipients now eligible for ERTC. So back in April and May, I was not in love, even into June, beginning of June, I was not in love with PPP program. My clients were closed, so they weren't going to spend the money. Like they were just going to take the money, spend it for people to stay home, and yeah, they would have some rent covered, but it wasn't a very helpful program. ERTC it could be extended through the end of the year, and it was when putting pen to paper, it was a more advantageous program for a closed restaurant when the PPP covered period was only that 8 weeks. Once the Flexibility Act came out, that kind of changed everything, and PPP became the more advantageous program. Now, the new law strikes the section of the CARES Act that disallowed PPP recipients from being eligible for the credit. So, and the amendment takes effect going back to the CARES Act. So that tells me that the PPP borrowers should now be eligible for ERTC going back to March 12, 2020. The caveat is you can't apply both programs to the same wages. So we're going to talk about how to come up with the credit, but just to show a very simple example and give you guys an idea of what kind of dollars we're talking about. If I received a $100,000 PPP loan and I spent $150,000 on payroll and $50,000 on non-payroll costs, I would apply $60,000 of my wages of the $150,000 that I spent for PPP forgiveness. I'd have the 60 of wages and I'd have 40 of non-payroll costs, even though I spent 50. And that would get me my $100,000 of full PPP forgiveness, and that would leave $90,000 eligible for ERTC credits, which is the $150 I paid on payroll and $60 I used for PPP forgiveness. So $90,000 eligible for ERTC would result in as much as $45,000 of ERTC credits that are now available to me. So this isn't, $100,000 PPP loan is not a big loan, and $150,000 worth of wages is not significant when you're talking about several months. So in this small example, $45,000 could be made available. So hopefully that gets your attention, and then we'll talk about the qualifications and eligibility. The mechanics of retroactively going back to get this money are currently very unclear. At this point, I have no idea. I would think that I would file an amended payroll tax return, but it doesn't appear to be that simple. I will say that I personally am not applying for any PPP forgiveness right now until I get more clarity on this. I don't want to apply for too much wages on PPP so I can preserve more for ERTC credits. In this example, if I applied for, if I just used $100,000 of wages because that was simple for me to say, okay, $100,000 loan, $100,000 worth of wages, I clearly spent. I'm going to take out more I'm going to use more PPP forgiveness for wages than I need to, and I'm no longer going to have those wages available for ERTC. So until I know this better, I'm kind of putting my putting a pause on PPP forgiveness applications right now. Refresher on ERTC computation. So it's based on wages paid from March 12th to 12/31 when either fully or partially shut down by government order. And with that, I think probably everyone on this call is already included in that since March. I think the continuous restriction should qualify all New Jersey restaurants as partially shut down, just given we're not fully operational. So I would say we're partially shut down. Or if I'm wrong in that assessment, experiencing large drop in gross year-over-year receipts. So at any quarter where we had a 50% drop from as compared to that same quarter in 2019, once that happens, we are in an eligible quarter. Every quarter is an eligible quarter until there's a quarter where we're at 80% when compared to 2019. So even in that category, if Q2 was Q2, you were below 50% because you were mostly shut down, then that means you're eligible for Q2 and Q3. If Q3 you had 80%, then you're done being eligible there, unless in Q4 you went back down to 50%, or if this partial shutdown applies. Again, I think the partial shutdown applies, so most of the people on this call should be eligible going back to March to date, really. 2020 credits are equal to 50% of the qualified wages paid to an employee, capped at $10,000 of wages per employee. So your limit is $5,000 per employee, and that's where I came up with $90,000 worth of wages in my example, got us to a $45,000 ERTC credit. You can increase those wages for amounts paid, allocable health insurance or healthcare costs paid for employees. So, and even in situations where you had to furlough someone, but you continued to pay their healthcare, you can claim the credit against those healthcare costs, even if they weren't technically an employee at that moment when you were paying that for them. For 2020, and this is what's going to rule some people out for 2020 going back to a certain extent. If you had more than 100 FTEs, then only wages paid to an employee during an eligible quarter to not provide services are eligible for the credit. So, I had businesses where they continued to pay everyone through the end of March, even though they were fully closed. Those are definitely qualified. I had people that paid everyone's health insurance for another month or 2 months. That would qualify. There are also examples where you might have a district manager, but and they're still on payroll, and they're still doing some administrative stuff, but the 90% of what they normally do is irrelevant for a certain period. There's IRS examples where, in that case, 90% of the wages paid to them would qualify for the credit. So just kind of think about, what was happening in March and April, and even now. I mean, you could be paying people that either aren't working or are working at a much lesser capacity, whether or not they qualify. If you had less than 100 FTEs, then all wages paid to an employee during an eligible quarter qualify for the credit. So there's no issue with whether or not you sent them home or they were furloughed or anything like that. Even working wages are included in the credit, which is pretty huge. Now for even better news. So the program's extended through June 30th, 2021. For 2021, there's an amendment that increases the percentage from 50% to 70%. And for 2021, there's an amendment that increases the maximum qualified wages to $10,000 per quarter, as opposed to $10,000 for all of 2020. So to put this in perspective, there's an employee that makes $10,000 every quarter. In Q3 and Q4 of 2020, the maximum credit would be $5,000. It's 50% of the $10,000 in wages that they were capped out at, even though they really made $20,000 in wages. In 2021, however, if that employee made $10,000 a quarter, the resulting credit would be $14,000, which is 70% of $10,000 of wages for each quarter. So just one employee can be $14,000 worth of credits. If you have 10 employees, it's $140,000. I mean, do the math on how many employees you have. And it's not like full-time equivalents. If you have high turnover and a lot of part-time employees, I mean, it can really rack up 70% of what you pay them, including their healthcare costs. Even better news, well, before I get to the better news, the threshold goes up to 80%. So before I talked about a 50% reduction to get you into eligibility, now it's 80%. Not sure that's going to matter if we're all still partially shut down. And for that, there's accommodations in place for businesses that didn't exist during specific quarters in 2019. But for 2021, the amendment increases the threshold number of employees before a change in treatment from 100 FTEs to 500 FTEs. So if what I was just talking about for 2020 didn't really help you much because you have more than 100 FTEs, if you have less than 500 FTEs, then all of this applies to you for 2021. So, and I mean, 500 FTEs, that's a pretty big operation. So I'm thinking a lot of the businesses on this call are going to be eligible for ERTC credits on top of PPP forgiveness, just not on the same wages. And the game I would play, well, the game I'm discussing here is ERTC expires July 1st, 2021. So, I'm sorry, July 1st, 2021. If I was to get the best bang of both programs, the longer I wait to get my PPP money and start that covered period, the more I can take advantage of ERTC credits first and then use PPP forgiveness. So think about a situation where you wait, you get your money at the end of March for PPP. You could, in theory, apply ERTC credits to all wages paid for the next 6 months maybe, and then use July, August, and September, because if you got your money at the end of March, you got 24 weeks of covered period, which is going to put you to September for a PPP covered period. You could, in theory, get 6 months worth of ERTC credits and get full forgiveness by paying 3 months worth of payroll to get to your 60% requirement in the summer, which is probably going to be busier for a lot of this group. So I don't want to tell everyone wait until the end of March to apply for PPP, because there's always a risk that the funds do go dry and you miss the boat because you listen to me. But I will tell you that an SBA director once mentioned to me that the United States has never let a disaster relief fund go dry. It's always been replenished. So again, I'm not telling everyone to wait as long as they can to receive PPP money so that they can get the best, take advantage of both of these programs the most. But it is a strategy that is in play if you were tolerant to that risk of PPP running out. So I hope that what I mentioned on the ERTC specifically was somewhat eye-opening. I don't think, like I said in the beginning, I don't think the program gets enough love. I don't think it's being publicized. I think PPP gets all the headlines for whatever reason. But hopefully this was informative